Sunil Koul, Asia Pacific Portfolio Strategist with Goldman Sachs joins us. Now let's take our conversation forward. Sunil, good morning. Thank you for joining us. Let's first start with the big picture overview on equities in general. I mean, it's not only in India. Globally also, with the exception of China, I think markets are in a good groove. So do you think rather than getting worried about India in specific, we should look at the big picture, and the big picture right now for equities is quite attractive?
Sure, Nikunj. I mean, thanks for getting me on. I mean, you're right. I mean, in fact, even China has started to recover from the lows. So we are definitely seeing a sort of a rebound rally in the region across Asia right now, and so the market is already up 12% from the lows. So I think the key sort of construct for the markets here is that, I mean, in general, and we'll come to that maybe in a bit, but valuations in general across the region are probably more sort of fair, and so we don't think there is a lot of room for valuations to re-rate in most of the markets. But what we are really looking for here is profits, and we do expect earnings to continue to recover in some of the markets in Asia, which is why we think the markets can continue to gain momentum here and be higher in 12 months. So for the region overall, we're still kind of baking in high single digit to kind of 8 to 10% returns for the overall Asian markets here. So it looks like things are still looking a pretty decent.
When you say 8 to 10% returns, the earnings are expected to grow in the region of about 10 to 12% or 12 to 15%, depending on the new universe you track. So are you making a view that in India now, markets may actually underperform earnings?
Yeah, that's a good question. Look, for the region overall, we are actually baking in 15% earnings growth for calendar 2023, another 11% for next year. But that's really upwardly distorted by deeper cyclical markets like Korea and Taiwan, which are coming in from very low levels. In sort of Korea's case, in round numbers, we're looking for 60% earnings growth. So if you strip that out, we are really looking for kind of a 8 to 9% earnings growth for the region as a whole, which is what our full year targets are. So that basically tells you multiples kind of flat on an aggregate basis, and the underlying 8 to 9% earnings growth kind of drives the markets higher. Within that, I would say India, we are baking in 15% earnings growth for the next couple of years. And I also like to make one point. Look, I mean, I think a lot of the people make the point that the market has done well. If you look at the underlying earnings, it's been 3-4 quarters in a row where earnings are coming in actually better than expected, right? So we just had the December quarter, which concluded, and profits were up 17% year on year, which basically took the calendar 2023 profit growth for MSCI India, similar Nifty, 20%. So what that means is that the 20% move in the index for last year was entirely driven by the underlying earnings. And so if you looked at the aggregate multiples, that for the index is actually flat year on year. So I think that's an important point. And the reason we continue to like India is because of this consistent earnings delivery. And so if you're right that earnings continue to compound at 15%, so lower than last couple of years, but even if we get 15% earnings growth, we still think market should be higher in 12 months' time.
Sure. Sunil, over the weekend, we were just going through Warren Buffett's annual letter to shareholders. And, one thing really stands out from there. He's saying, I mean, obviously in correlation to US equities, the markets are now exhibiting a far more casino-like behavior, saying that the casino now resides in many homes and daily tempts the occupants. Correlate that to India. Do you see pockets or signs of any exuberance or risk-taking ability, if you will, here in India?
Yeah, I mean, before I answer that, I mean, I just saw the targets being flashed on your monitor. So I would like to correct that our sort of year-end target for Nifty is 23,500. So as I said, we're kind of still looking at sort of roughly high single-digit returns, even from current levels for the market. I mean, look, I think obviously there have been pockets of the market that have run up quite a bit compared to fundamentals, and I mean, PSU, for example, is a good starting point, wherein it seems like obviously the index is up almost doubled in the last 1 year. Some of the pocket in those could be justified. I mean, for example, power, for example, defense. Whereas if you look at some of the other stocks like OMCs and banks, we don't think that move was warranted. So clearly, I think there are some pockets which have run up overall, but I think overall one of the core views we have coming into the year, and probably that manifests more after the elections, is that you should see rotation in the markets, and as foreign money comes back in, you should see large caps kind of taking the lead again, and I think that's where we are kind of more focused on.
Okay, so that's a view coming in. But are you getting a lot of pushback when it comes to the private banking performance in India? Because your top bets remain HDFC Bank, ICICI Bank, even IndusInd Bank features in that list. What kind of feedback are you getting from investors on that?
Yeah, look, I mean, the large cap private banks have obviously been underperforming almost for a year now. I would say, look, I think near term, there are clearly some headwinds, right? I mean, we do think sort of there are two issues going on. One, I think the cost of funds will continue to rise for the banks. Number two, I think as is well flagged by now, there are obviously pockets of concerns on the consumer leverage, right? So we do think profitability comes under pressure in the near term for the large private sector banks. And so ROA should start to moderate, both in terms of loan growth slowing because your loan to deposit ratios are stretched, but also margins coming under pressure. But I think the way we are kind of positioned in the banks is that we are more selective there. So one of the themes, intra-bank themes we have is that of favoring commercial retail oriented banks over the consumer oriented banks. And I think that rate will continue to play out.
Let's understand this earnings of double digit. What gives you a reasonable amount of confidence that earnings will be in double digit? Because you are getting signs of slowdown. I mean, signs of slowdown are there actually in some of the popular categories. For example, autos, for example, real estate. What gives you the confidence that we are in for another good year of double digit growth? Because double digit growth on this kind of a base is incredible.
Yeah, I mean that's a great question, Nikunj. Look, I think one, as you very well know, we have been seeing this slowdown for the last 2-3 quarters now, whether it's in the consumption space, whereas obviously in the new orders in terms of infrastructure also heading into elections, right? Despite that, when we came into the year last year, we were looking for around 18-19% profit growth, and the market delivered 20%, right? From current levels, the way we're kind of looking at things is that if you look at the last year, as I'm sure you know, I think the key sort of construct there was that your demand was still slowing, which we just discussed, but your margins came through, right? And so much of the earnings growth actually came in from margin expansion, right? Looking forward, our sense is that from very low levels, sort of 5-6% earning and volume growth or sales growth, you should start to see things improving a bit over the next few quarters over the course of the year. And so we are baking in like 7-8% volume growth and then some moderate expansion in multiples, which should get us to that 15% number, right? On the composition there, I would say, look, on the consumption pockets, as we all know, high-end consumption still continues to do very well. We are hopeful that some of the discretionary bit, especially the mass market consumption, should start to improve, especially given that inflation has come down, and that means disposable income should start to improve as well. So that would be a positive delta, I would say, compared to last year. IT on the margin has also started to bottoming out. I think we think that December quarter was where growth bottomed out, and we do think earnings should start to improve there as well. We are baking in 10% earnings growth for the IT sector compared to low single digits last year. Keep in mind also that 60% of the revenues, they're coming from US, and we as a house have a above consensus view on US growth, and we have been sort of not in the recession camps and for a year or so, and that seems to be already playing out. So I think that should kick in, and then we do think there are some signs already in the data that private capex should come back after the election. So if you put up all of that together with a bit of improvement in the volume growth and some margin expansion, we do think that 15% earnings growth is realistic there.
How much of this earnings growth template, which is now more like a consensus view, is in the price? See, markets, you'll make money if you find something which nobody is betting on. So the fact that India is growing, India will grow, India will continue to grow, earnings will be in double digit. It's more like a ghar ghar ki kahani.
Yeah, I think that's right. I would say, I mean, even in our sort of broader Asian allocation, we do think India is one of the structural growth stories out there in Asia, and that's pretty much what a lot of the clients agree to. And as I said, if the earnings continue to grow double digit, even with some moderate valuation compression, which we do bake in our numbers, you could still get decent upside on the market, right? I mean, in the near term, things could flatline, and we do think post-elections probably market goes higher. But in a lot of the other markets in the region, earnings are much more cyclical in nature, and you're coming in from very low levels, so you get that boost. But for India, obviously the macro looks very good. As you said, growth is looking pretty decent, and if earnings continue to come through in double digits, that should get markets higher. And within the market, obviously, we have been seeing that there is enough dispersion both at the sector and the stock levels. And as I said, one of the core views we have is that you should see rotation into large caps, which haven't performed as well, and B, there also could be rotation back from value to some of the sort of quality pockets as well. And so that probably takes the leg higher in terms of markets.
All right, Sunil, really appreciate your time. So glad you could join us. And I look forward to the Goldman Sachs view more on a regular basis. Don't get too much of Goldman Sachs on the channel. I think we should book our next appointment soon.
For sure, we'll aim to do that. But really pleasure coming in here.
All right, now, I'm just